Welcome back, my friends. The news today is that San Francisco's biggest landlord defaulted on a massive loan. According to a report from Fitch Ratings, Veritas Investments, the largest apartment landlord in San Francisco, defaulted on a $448 million loan and was transferred to special servicing on November 3, 2023. The loan was not paid off by its November 15th maturity date. Veritas owns 62 multifamily properties with a total of 1,734 rent-controlled units located across San Francisco. The loan is backed by this portfolio of properties. But before we get into all of that, I would like to thank everyone who views my videos. If you would like to support the channel, please see the link to Buy Me a Coffee in the video description below. And please hit the like button and leave me a comment below. I would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. In a sign of growing distress in San Francisco real estate, the city's largest apartment landlord, Veritas, defaulted on a $448 million loan according to a report from Fitch Ratings. The loan was transferred to special servicing on November 3, a stage meant to allow for negotiation, and was not paid off by its November 15th maturity date. According to Fitch, the loan sponsor, a joint venture between Veritas and hedge fund Bellpost Group, indicated it was not going to exercise its one-year extension option or be able to pay off the loan at its maturity date. The parties said they were hoping to find a partner to help refinance the properties. In a statement, a Veritas spokesperson pointed to spiraling debt costs, layoffs, and other challenges and said the company remains committed to San Francisco. While we've all seen the stories about office usage going down in the wake of hybrid work, multifamily operators in San Francisco have to contend with even more challenges, including increased city regulation, increased taxes, more pandemic impacts, and the rising cost of doing business here, said the spokesperson. Research from financial services company Moody's said maturity defaults like the one Veritas is experiencing and eventual delinquencies are likely to increase in line with rising interest rates and largely stalled capital markets. Rising interest rates have made it more difficult for real estate players like Veritas to refinance their loans as lenders are seeking higher rates of return. That can be an especially difficult prospect in a market like San Francisco, which is still reeling from the impacts of the pandemic. Veritas's loan is backed by a portfolio of 62 multifamily properties, with a total of 1,734 rent-controlled units located across San Francisco. Fitch reported at the loan's offering date that 12% of the total units were vacant to allow for renovations, with the eventual idea they would be rented out for market rate rents. But during the pandemic, demand for small apartments cratered and triggered an exodus from San Francisco, from which the city has not yet recovered. It remains one of the only metro areas with rents that have failed to recover to pre-pandemic levels. Veritas's situation mirrors that of Shorenstein Partners, which defaulted on a $400 million loan on the Twitter headquarters building at 1355 Market St. Somewhat ironically, Veritas itself was formed from the ashes of the Lemby family, the city's top apartment landlord prior to the Great Recession. After Lemby lost dozens of buildings to creditors during the financial crisis, Veritas swooped in and purchased a portfolio of more than 2,000 units for $500 million. Since then, Veritas has continued to amass properties in the city, including a $33 million purchase of a 42-unit at 2242 Polk St. in November. Meanwhile, it has garnered a controversial reputation over its eviction policies. All told, Veritas owns more than 320 buildings and 7,500 apartments across the Bay Area and Los Angeles. The massive loan default by Veritas Investments, the largest apartment landlord in San Francisco, was caused by several factors, such as the loan had a short-term maturity of only 3 years, which means Veritas had to refinance or pay off the loan by November 2023. The loan had a low interest rate of 4.75%, which was below the market average at the time of issuance. This made it harder for Veritas to find a new lender or investor willing to offer similar or better terms. The loan was backed by rent-controlled units, which limit the amount of rent increase that Veritas can charge to tenants. This reduced the potential income and value of the properties, especially during the pandemic when many tenants faced financial hardship or moved out. The loan was transferred to special servicing, which is a process that occurs when a borrower is in default or at risk of default. This usually involves higher fees, stricter terms, and less flexibility for the borrower to negotiate or restructure the loan. These factors combined to create a situation where Veritas was unable to refinance or pay off the loan by the deadline, resulting in a default. Veritas is now facing the risk of foreclosure or forced sale of its properties, unless it can reach an agreement with the special servicer, or find a new source of financing. The multifamily commercial real estate distress in San Francisco is a situation where many landlords and developers of apartment buildings are facing financial difficulties due to the impact of the pandemic and other factors on the rental market. Some of the reasons for this distress are some that would not previously be expected in San Francisco. The decline in net cash flow, NCF, which is the income generated by the properties after paying operating expenses. According to a report by TREP, a data provider for commercial real estate, approximately 43% of multifamily properties in San Francisco have seen NCF decline by 5% or more. This reduces the ability of the owners to service their debt and maintain their properties. The decrease in occupancy and rent levels, which are influenced by the supply and demand of the rental market. The pandemic has caused many tenants to move out of the city, either due to job losses, remote work, or seeking lower-cost alternatives. This has increased the vacancy rates and lowered the rent prices, especially for high-end units. Moreover, San Francisco has a large share of rent-controlled units, which limit the amount of rent increase that landlords can charge to existing tenants. This further constrains the income potential of the properties. The difficulty in refinancing or paying off maturing loans, which are the debts that the owners have taken to acquire or develop their properties. Many of these loans have short-term maturities of 3 to 5 years, which means the owners have to either find new lenders or investors to refinance their loans, or pay off the principal amount by the deadline. However, due to the decline in NCF and property values, many owners are unable to meet the requirements or terms of the new loans, or generate enough cash to pay off the old loans. This leads to defaults or delinquencies, which are situations where the owners fail to make their loan payments on time or at all. This can trigger foreclosures or forced sales, which are actions taken by the lenders or servicers to seize or sell the properties to recover their losses. These factors combine to create a situation where many multifamily commercial real estate owners in San Francisco are struggling to stay afloat and avoid losing their properties. This has implications for the city's housing affordability, supply, and quality, as well as the overall economic recovery. But what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. And before we end, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school, as well as any kind of job that requires a government license or certification. And ProWorldNet.com also includes short-term gig-type jobs as well. So be sure to check out ProWorldNet.com if you are looking for a job or an employee. Thank you for watching.